G'day and welcome to this week's podcast. My name is Robert Goudie. This is Amy. This is, of course, also going to be put onto YouTube as well. So not just a podcast, but also on our YouTube channel as well. So for those people that are seeing us on YouTube, we also have Investor Motivation Podcast, which will be on Spotify and Apple and can be found on our website as well. I've got Amy with me. Welcome, Amy Lehman.
Hello, Rob. How are you?
Well, thank you.
That's good.
Yeah. Today we had Emma Fisher from Airlie Funds Management and had a really good conversation with her. Emma has been in the funds management game for the last 13 years. She's a portfolio manager with Airlie and looks after the Airlie Australian Share Fund for the last 5 years. So she's a wealth of experience and she's seen a lot over a very short amount of time with COVID, with higher interest rates, with corrections and crashes. So lots happening. So a great amount of information and common sense.
I'm excited to be a listener in on this one and can't wait to hear back the recording.
Right at the end of the conversation, she really talks about I suppose the emotional side of investing and I suppose her personal journey and how much she enjoys what she does. So that was nice to hear.
Yeah, awesome. Can't wait. All right. Well, before we get into that recording, I'll just read out the acknowledgement of land. On behalf of the Investor Motivation Podcast, I would like to acknowledge the traditional custodians of the land on which we record this podcast and pay our respects to elders past, present and emerging.
Fantastic. Thank you, Amy, and thanks everyone for listening. Please enjoy. Welcome, Emma Fisher from Airlie Funds Management. Welcome to the Investor Motivation Podcast.
Thanks so much for having me, Rob.
Thank you. And you've been a portfolio manager since 2018 at Airlie, and what a rough 5 years.
Yeah, I know, baptism by fire. It feels like I've managed coming up to 5 years now of running money. I managed to have somewhat encapsulated a full cycle, which is always good.
Yep.
You learn a lot of lessons.
Yeah, we've always said that it's the tough times when you improve and have the real life lessons, not just the theory that make a huge difference to us as advisors and investors. What are the key takeouts for you, Emma, do you think, over these torrid times?
Yeah, look, I feel as though my whole career, so I started investing professionally. It's basically the only industry I've ever worked in. I've had a bunch of retail jobs, checkout, chick at Woolies, things like that. But straight out of uni, I went into this industry. And so that would have been 2010, my first year. And I feel as though the years from 2010 to 2020 were one kind of cycle. And it was, you were on a treadmill going up. And that was interesting because really, you saw when I first started investing, no one wanted to pay more than 12 times for a business, 12 times earnings, and you didn't really have to. There were great businesses on the ground. I remember in 2013, I picked up the healthcare sector and I was looking at CSL, and I just, really had to get my head around the valuation at I think 21 times earnings, because everything that I was used to looking at was so much cheaper than that. And basically the story of the next decade was all the businesses that you knew were good, every year they became more and more expensive as interest rates ever ground lower. And that was actually quite a frustrating period as an investor with a bit of a, a valuation tilt. It was frustrating because you do all the work and you correctly identify the best businesses, and then maybe you don't want to pay a certain level for them, and then you watch them go on and you rue your mistake. So, I mean, CSL is one that we did get our head around, and we've owned that in the fund, for the better part of a decade. So we've enjoyed that. But then there have been other ones like REA. I did a lot of work on that. REA, the realestate.com.au, did a lot on the work on that maybe 7 years ago. I thought it was the best business I'd ever seen, but they were at the time burning a lot of capital overseas. I didn't believe in that story. And I was worried about that combined with a very high valuation. I thought, well, when everyone realizes they've just dusted $1 billion expanding overseas, people will be really bearish on it and it will derate. And that's when we can buy it. And funnily enough, I was actually right that they did burn $1 billion overseas, and they've subsequently had to write that off, but no one cared. The value of the core business in Australia showed how powerful it was in terms of untapped pricing power, and the stocks never looked back. This was, all the work I was doing, the share price was $50 and today it's like 130. So I've learned a lot of lessons over that period of how to navigate an environment like that. And then you had the pandemic come along, and that 3-week, it's funny. So March 2020, I was 37 weeks pregnant with my first child, about to go on maternity leave, and the world started to end and melt down. And I remember thinking, this is really annoying that I've worked my whole career in one type of cycle, and we're about to see something really interesting, and I'm going to go off on maternity leave. Sorry, I was about 34 weeks pregnant, but luckily enough, I managed in that 3 extra weeks I was working to capture the whole down cycle. And it was a really interesting lesson for me, because I remember watching, you know, you own a business, maybe you've been invested for 5 years and the stock's doubled over time, or it's up 50% over the 5 years you've invested in it, and you're feeling great about it. And you're watching that upside get evaporated in a couple of days. Yes. You know, suddenly the share prices of these businesses are below what you paid for them 5 years ago in a matter of 2 or 3 trading sessions. I'd never seen anything like it. In fact, no one I'd worked with, and I worked with some guys that have worked in the industry for 30 years, no one had seen anything like it. Yeah. There was one day where the ASX closed down, I think about 8%, and that was the worst fall since, I think, 1982. So nobody working today had seen gaps down like that. And I remember thinking, you know, at the time everyone was saying, if you look back to the GFC, which was everyone's most recent memory of a market fall, the market was falling for 2 years. Mm-hmm. So there was this sense that even though the prices on offer were tantalizingly cheap, you were 3 weeks in. So there was this sense that we'd all have time. You know, we'd have time to analyze the data. We'd have time to look for green shoots. We'd have time to figure out, you know, how deathly is this thing going to be? We'd have time to figure out, you know, the progression of border closures and how long that was going to last and all of that stuff. But the reality is we didn't have time. And I remember having this discussion with a guy that I worked with, and we were both sort of saying, the forces that are making these things gap down, you know, share prices were down 30%, 40% in a day for some stocks. Yeah. That can work the other way. And you may think that you're going to have time to analyze that positive data point, put it in your model, say now's the time to, you know, add to positions. But those stocks are probably going to be up 40% in that one day. And so it sounds like in hindsight we were geniuses, but we didn't go hard enough. You know, we started to selectively add to things, and everything we added to, anything you could have thrown a dart at a dartboard and made money at that time. Yes. So we weren't geniuses in what we did, but that mindset of being like, okay, the fear is there now, we need to act now, even though really our action was somewhat dipping a toe, and in hindsight we would have been really, really swung at it. I think it was still a kernel of the right idea. Right. So that was a really powerful lesson. I think all the forces that are at play in the markets today, in terms of, I don't know, automatic trading and algorithms and things like that, it's going to make these cycles shorter, sharper, and you just have to act, even though you think it hasn't gone long enough. Yeah. So you never laboured on, you know, building into your models. You didn't think too hard about it. You just knew emotions were in your favour, and these are the opportunities that the market throw at us, whilst everyone is panicked and. Well, we had to have a framework to organise everyone around how do we sift through these opportunities. And for us, the first part of our process is balance sheet, and that. You know, in the GFC, the question was it was a liquidity crisis. It was how a business is going to be able to roll their debt when nobody wants to lend. So you were looking at that. And this time it was really a solvency crisis. It was, if no one has any revenue coming in, how many months can they stay afloat given their cash balances, given their, you know, working capital funds they can draw down on and things like that. So we got all our analysts to just drop everything they were doing and look at everything we owned and everything that we liked, and to go through the detail on answering that question of which one of these businesses can self-fund through this for the longest period of time. And that gave us conviction, I suppose, to add to those businesses where we thought. So a business like James Hardie, for example, you know, it was one of those ones that was down 40% in a couple of days. And, you know, we knew pretty quickly, we knew the balance sheet was good. They didn't have any debt that was due in the next 3 years. They could scrap all their capex plans like that. They didn't have anything in train. They weren't pre-committed. They already owned the land for a lot of these things. So it was just a matter of, you know, pushing it out a couple of years till things improved. And there was, you know, they could batten down the hatches, and they didn't have a lot of external obligations that they had to meet. So that was one that we felt we could add to. And then, we cut our position in financials to fund some of these, because obviously financials, the leverage there, you didn't know what a bad debt cycle was going to look like and what was going to happen to unemployment. So they were sort of funding sources. CSL was another funding source because it was pretty clear up front that they have a huge US collection base, and it was going to be really difficult to incentivize people to leave their houses and want to go get paid to collect, to donate their plasma. So that was another funding source that we used. So it was just thinking through things like that, like where can we tilt to the less riskier propositions, but still add exposure to the market at a time where there was a lot of value on offer.
Yeah, fantastic. Thank you, Emma. With looking at your 29, around 30 holdings in the portfolio at the moment, and top two's BHP and CSL, which you mentioned before. And CSL, probably in the last 4 or 5 years, has traded between 250 and 340. And obviously that's the short term, and we know that they're investing all the time, reinvesting back into their business with acquisitions and so on. But yeah, what's your longer term outlook for CSL? It's obviously it's the darling of the Aussie market, and for those that were lucky enough to getting it at 80 cents back in 94, 95, it's been a portfolio maker. What's your outlook for the coming decade?
So look, it's really hard to predict where share prices are going. The thing that we focus on, that we believe in over time, is if you can predict the direction of a company's returns, the share price will usually follow.
Yep.
So the reason why CSL, as you say, has sat in this range of 250 to 340 for the last few years is their returns. For decades, their return on invested capital kept increasing, and now it's come right back down. And it's come down for 2 reasons. The first one is, most recently they bought V4, which has weighed on their returns because they aren't, their view is that the earnings of that business aren't reflective of what they can do with it over time.
Yes.
So it's currently just weighing on returns, and then they build the returns from there. So they spent the money and then they get the returns. So that's one thing that's sort of easy to understand. And then the other thing that's really weighed on their returns is they have spent 2 decades now building out this US collection center network for blood plasma in the US. And during the pandemic, no one wanted to donate. They didn't want to leave their house. And in order to get them to donate, you had to pay them a lot more.
Yep.
So volumes fell and the cost to collect went up a lot. So those 2 things really crunched their returns. And now what we're seeing is the opposite happen. So people are happy to donate. They want, it's a cash flow thing for a lot of people. They donate weekly and they get a nice income stream from it. It's about $90 US a week that they're getting from it. And so the volumes are picking back up, normalizing. And as a result, related to that, they don't have to pay people those super incentive pricing to get them to come out of their house. So their main cost is falling. And when you think about the market and inflation, how many companies are there out there right now whose main input cost is falling in this inflationary environment? It's pretty rare. So that's why we like it. That's why we think this, the nowhere land that it's been in for the last 3 years, we think that it comes out of that and returns start to improve from here as collections normalize. And it just goes back to the old story, which is so the main product that they sell, IVIG, it's a 30-year-old therapy, and demand for it has grown at about 6 to 8% per annum for 30 years. I can't think of one industry globally that's had that kind of demand profile for such a long time. It's pretty incredible. So not only do they have their core product growing 6 to 8%, very underdiagnosed, very underused, but then they're taking share within that market because they're the best competitor. They're rolling out more centers than their competitors. So we think it's basically back to the old story with an added layer of what they can do around V4. And that's one that we like. It's interesting when you look at our fund, it can be a bit misleading looking at our largest positions in the fund, because it's what we like to look at is our active weight. So BHP, for example, it's about 7% of the Australian index. To express a positive view on it, we have to own maybe 8% of it. And really we're only 1% overweight. So it's actually not, in my mind, it's not one of our larger exposures. Same with CSL. We've at one point we were actually underweight CSL, and now we've really ramped it up. Now it's moving towards a 2% overweight position.
Yes.
So they sit at the top of our positions. But in terms of our active exposure, or beta versus the market, the two biggest positions that we have are Mineral Resources, which has been a cracking performer, but we think it's one we really like for the next decade. It's as they build out their lithium production. And then PWR Holdings was another one. It's a great little small cap. They do cooling systems for motorsports, including Formula One, and they're expanding that into other areas. Now, that's one actually that we've reduced our position size a bit because the share price has risen so high. So on valuation grounds, we had to sell a bit of it, but it's still one of our larger positions.
Right. And with PWR, Nick Scully and Reese, obviously there's a lot of internal ownership in these businesses. And is that a key theme to some of the, particularly in the smaller cap space, that you want the people running it to be the founders, the management? How much weight do you put into that, Emma?
We put huge weight on it. I think we've just felt anecdotally over time that some of your best investments can be when you're investing alongside these founders, because they have a really long-term view. They're really passionate about the business, and they create these really unique cultures. And it stands to reason when you've got all your wealth tied up in a business,
yep,
you tend to be a bit more long-term focused than, management teams that are sort of here for 4 or 5 years and then they move on to something else. So it's easy to have that long-term focus when it is your baby. It's not foolproof.
Yep.
So, you do meet some people that run their own business that you wouldn't want to invest alongside. Sometimes it's because you're going to be treated a bit like a minority holder. You're subject to the whims of wherever they want to take that business. A good example of that one over the years, although, from a share price perspective, you've probably done very well, but Harvey Norman, there's been multiple instances of the founder investing in things that probably rightfully should have been invested in with his own money rather than the company's money, because they're a step outside the core. You think you're investing in this retail business, and then suddenly you're in dairy farms or you're in mining camps. And things like that. So it's not foolproof. And we're always applying, I guess, our own judgment to it. But we've just had such great, when you can find a really great owner-managed business that's focused on the long term and building these unique cultures, a business like Reese, it's been a 50 bagger over the last 20 years.
Yeah.
That's all been because the Wilson family have been so focused on the long term.
Yeah.
The guy that I work with, Matt Williams, he's loved this stock for years. He always talks about it. And he tells this great story about a time when he was younger and, they get delivered a result where sales grew, but costs grew a lot more. And so profits went backwards and the stock was down. And he spoke to the management team and, it's basically saying, well, why are you just growing costs when the cycle's starting to turn? Can't you cut back on costs? And, the family that ran that business are like, we just invest through the cycle. If we cut back on costs now, then we're ceding share to our competitors. We're going to absolutely squeeze them because they'll be the ones cutting back on costs and we'll really be going for it. And they were totally right on that. Yeah. So that's an example of how on our side of the fence, we all say we're long-term investors, but we want the stocks to work right now. We want them, we want them working every single 6 months for us. And sometimes that leads us to short-term thinking and short-term pressure. And when you're a management team that don't really care what these minority investors think, if you've got the right stuff and the right kind of values and everything and the right game plan, you're probably right to ignore us and the short-term pressure that we can sometimes put on companies.
Yeah, there's no doubt that with the amount of information and access to portfolio valuations on a daily basis, intraday, I see that our clients are just looking too often and barracking for a portfolio value or barracking for a share price. And to say that it's actually not about that, you've got to, look through and see what is the business doing, because purely barracking for a share price is not helpful. And it causes a lot of undue stress. One thing that I get from my clients is, Rob, I need, and this is generally retired male men, say, Rob, I need big dividends. And my reply to that is, look, we shouldn't just focus on high dividends. We focus on high quality businesses, and just focusing on one element is a bit of a blunt axe. And CSL and many of the businesses you invest into And CSL is the poster child example for me that they've never paid a big dividend. The payout ratio has been relatively low because they reinvest. How would you frame that discussion to those types of clients that demand a high dividend?
Yeah, look, it depends on the business, right? So if a business, there are a lot of businesses in Australia that I would put in the basket of what I would call a bit of a legacy mode. And what I mean by that is they've got a great position. If you look at the annual report, you can calculate a really high returning business, but their ability, so let's say a business like, before it was taken over, Coca-Cola, they made a return on invested capital of around 20%, but that was a bit of a misnomer because their ability to find a big project to invest a lot of money in and earn a 20% return on, they just didn't have that ability. Yeah. They threw off a lot of cash. They didn't have a lot of need for that cash. And so in that instance, they should pay that all out to shareholders. Yes. And let shareholders take the money and diversify and stick their dividend stream into a high growth business. The worst thing you want is a company that's low growth, high return, so it throws off a lot of cash that it doesn't need for its own purposes. And then the management team take that cash and they diversify. Yep. You go back to the 80s and conglomerate models, like, it's a train wreck. The only one that I think of that's really worked has been Wesfarmers, and they seem to have quite a good DNA around these things. They're a bit more like a long-term private equity kind of business. But most businesses just torch capital. It's this term diversification. Right. So if a business generates a lot of cash and isn't giving it back to shareholders, we're really wary of that situation because we think that management are probably just going to torch that cash. Right. So if you're in a low growth, high returning, stalwart business with a bit of a, yesterday's hero, they're tapped out of growth, but it's this really dominant position. Maybe even I'd put the supermarkets in that category. Really, You're in there for the dividends. You're going to get a little bit of growth, a nice solid 4 or 5% dividend yield, and that forms a really nice part of your portfolio. Right. So we own some of those businesses. Yes. And then there are businesses that have a lot of, this is the dream, businesses that have a lot of opportunity to invest in their core business and generate good returns. And CSL has been the poster child for that. They've stuck about $1 billion a year of capital back into their business, and every year they grow their earnings by about 30% on the back of that $1 billion. So they're generating a 30% return on it. Sorry, they're not growing their earnings by 30%. They're generating a 30% return on that incremental capital. And that's when you hear this phrase, earnings compounder, that's what that means. That is a business that's able to allocate big chunks of capital and earn a really good return on that year after year after year, and that's how they grow earnings. So that's one type of business, and they're not going to pay out dividends because they have opportunity to invest in something special, and they should do that every day of the week. Yep. Then there are businesses that are even better than that, and they're businesses that can grow without capital. Like, they're pretty rare. So they're going to have the combination of a high payout ratio because they can grow without needing to reinvest back in their business. Now, these are usually, like, if you think of a people business, so there are always some risks around this. So one example would be a fund manager. When I say we don't need capital to grow, our capital listed on our balance sheet is what, desks and computers. I can't go out, buy twice as many or 3 times as many desks and computers and double or triple my earnings. There's no relationship between that investment and earnings. Yep. So I don't need capital to grow. I need good people to grow. And that's reflected in the profit and loss statement, not the balance sheet. So yes. I can grow without capital, throw all that cash out to shareholders. And if I'm winning share and FUM's going up, it's a great ride. Obviously, there are risks within that model. Any people business, not just fund managers. I look at, in healthcare, there's a lot of doctor models, for example. So, yes. Helios, the pathology players, diagnostic imaging players. It's a similar thing. They don't need a huge amount of capital to grow. But they're their own risks around, navigating doctors who really own the patient. So if you look at, the listed fertility players, for example, one of the challenges with that industry is, it's great, doesn't need capital to grow, it's really high returning, so they pay good dividends. But the challenge is that the relationship is between the patient and the doctor. So you do have these kind of rock star doctors that can leave one of these groups, and those groups lose a lot of market share with that. And they go and they leave, and then they start their own clinic, and so it's hard to kind of keep your market share all together. The corporate finds it difficult to really have much bargaining power in that situation when they're up against these rock star doctors.
Yeah.
So those are the kinds of things that we think about. You want to put a company into its own bucket and make sure that its payout ratio, its dividend policy matches the nature of its business and its opportunities, and that they're not keeping the cash and investing it in really poor returning options.
Yeah. And Emma, in terms of, returning capital to shareholders can be dividend, but also you mean share buybacks as well, that same apple?
Yeah, exactly.
Yeah.
And often when a company earns a lot of their earnings overseas, like CSL, it's less efficient sometimes to return it via a dividend because you won't have the franking credit. So sometimes it could be more efficient. So one example of this is James Hardie. Most recently, rather than paying a dividend, they moved to a buyback.
Yes.
They thought because the share price had come down that was a more efficient use of their capital to buy back shares at this low price rather than just pay it out as a dividend.
Yeah.
So yeah, when they generate most of their earnings in the US, so that makes sense for them.
Yep. And CSL over probably the last decade and a half have done constant buybacks over time, and it's just seeing what happened with Facebook overnight. It was up around a bit over 23%. And it's, I suppose, from an emotional point of view, from investors, it's seemed to be the height of pessimism for that business. And then, as usual, the business is working away in the background and actually does a bit better than expected. And the share price jumps 23% and announces a $40 billion share buyback. So, is much of opinion on Facebook at all, or Meta?
I would be giving you a fool's opinion because I'm very uninformed there. The one thing I've always thought about Facebook is within my own lifetime, I've seen MySpace be disrupted by Facebook, and then I've seen Facebook be disrupted by Instagram. And luckily enough, they own Instagram, and then Instagram is now in the process of being disrupted by TikTok.
Yep.
So you own these businesses, your share price is sort of implying a long-term, value of these businesses are going to make cash flow for the next 30 years. And in the 20 years that I've interacted with social media, or probably even less, 15 years really that it's been around, we're now on the fourth wave of what's hot. So yes. I personally think the disruption risk in that portion of the industry is clearly quite high, because we've all experienced it ourselves that, once everyone moves off a platform, you just stop using it. It's not cool anymore. Like I remember Billabong in the Aussie market. Once the dads started wearing Billabong, the kids stopped wearing Billabong. And it's a little bit the same with Facebook. Like, your nan starts posting all these things on Facebook and suddenly you don't want to be on there anymore. And it's the same, the generation below me on TikTok, I wouldn't be caught dead on TikTok. Yep. And they don't want me there, believe me. Like it's the young people that are trying to get away from us loser millennials that are on Instagram. And we went to Instagram to get away from the boomers that are on Facebook. So it becomes, we're willing to swap to whatever the next thing is. And I actually think that, there'll be a terminal value there, really. And this is where, as you say, expectations get too nasty and too low. And this is still a business maybe in decline, maybe in terminal decline, but it's going to make a lot of cash between here and there. Because as much as I say, I don't want to go on Facebook anymore, I still have a Facebook. And they, so they'll make cash, they'll make, probably a declining level of cash. I think the other problem is that, that their business model is the core of their business model is time spent on device. That's what allows them to monetize it. And you've had a decade where we've gone from desktop to mobile, which was great for their business because you suddenly went from only spending time on a device when you were near a computer to being permanently around a device. So their time spent on device went like that, and they were able to monetize that in terms of revenue per minute, I suppose, that you're on that device. And I think that's capped out. If anything, hopefully, fingers crossed, we all start spending less time on our devices. So I think, there are a lot of reasons why we were probably at peak Facebook a couple of years ago. Right. But that doesn't mean that you can't get times where that business is in a fantastic investment where people get far too bearish. We've owned Ampol in our funds for years. And that's one that we all know has a bit of a sunset at some point. Petrol stations aren't going to be around forever in their current format. But, they own a lot of property. That property's worth something. There's a lot to that side of it. If you look at I think it might have changed recently, but certainly till about 2015, the best returning sector of the 30 years prior to that was tobacco, because they they're the ultimate sunset industry. It's not a volumes thing, it's pricing and the discipline to just pay all the cash out to shareholders. So rather than, a few decades ago, they were going down that path of diversification. They got the message, started paying it all out to shareholders, increasing pricing, and it's been a great returning sector. So it's not the case necessarily that a sunset industry is always about investment. Actually, you get very little competition. Nobody wants to enter. And if you're the last person standing, you can generate great cash flows as long as you're just paying them all out to shareholders. So that we've got open minds on these things.
Yeah, fantastic. Emma, just I suppose more broadly as a fund manager, and when you've got a universe of nearly 2,000 businesses in Australia, where do you start to sift through to focus down on that top 40 or 50 businesses that might be investment grade? What's the process?
Yeah, it's a good question. The thing I like to start with is returns. I've talked about returns a lot, and to me, they're really important because if you see a company that's made a sustained high return over a long period of time, it's like a big sign that's saying something special is happening here.
Yep.
And that's what we want to really get into and understand what's going on in this business, because traditional competition theory is basically that if I'm able to make a high return, my competitors are going to see that, they're going to open up next to me, and they're going to bid that return down to normal.
Yeah. And Emma, when you say high return, you're not talking about high share price return, you're talking about profit or margin on
return on capital. So I'll give you an example. If I had 100 grand and I, as Emma, thinking, what do I want to do with my life? I've got 100 grand. What business can I open? And I go, I'm going to open a hair salon. So I put my 100 grand into my hair salon. Turns out I'm a great hairdresser. I'm not, by the way, but I'm a great hairdresser. I've really got something special, and I've picked a great location. I've done a beautiful fit out with my 100 grand, and people come in and I charge them through the nose, and I'm making a great return on that 100 grand. Maybe I'm making 20% per annum. That's a really high return. I always, in my head, my yardstick of an average return is about 10.
Yep. So
to make 20% on that capital is a really special business. Now, normal competition theory, the problem with a hair salon is my competitors could see that I'm charging through the nose and getting away with it. Maybe they open up down the road. Maybe they pinch my staff. Either way, whatever happens over the years, that 20% return is going to get bid down to an average level. Once it's back at that average level, people will go, oh, there's too many hair salons on that particular corner of the road, and I'm probably just going to start making that normal return for a while. So that's a normal business. That's a cafe. That's a hair salon. There's a business that has no real barriers to entry, nothing special going on. A lot of the businesses listed on the stock exchange, particularly the largest ones, they're that big because they've got something really special about them. And that's why I love investing, because I can only put my money into so many ventures that are available to me as an individual, and very few of those are likely to have something special going for them that mean I can earn a sustained high return. But as an investor, I can hitch my wagon to, CSL. I can hitch my wagon to Wesfarmers, which own Bunnings and generate most of their earnings from Bunnings. And I think we all know that that's one of the best businesses in Australia.
Yes.
So, these businesses that can sustain a high return, where competition theory says that's going to bring in competitors that are going to push it down, you got to try and understand what's going on, that they're able to stop that competition from. That's a really interesting one, because that was competition theory playing out in practice. So you had Woolworths, very well capitalized, good retailers, knew what they were doing, and they said, hang on a second, we want a slice of that pie. Bunnings has no real competitors. We're going to go in there with Masters, and we're going to eat that profit pool, and we're going to make some money. And of course, we know they didn't. They made a lot of mistakes. They invested a lot of capital, and in the end, Bunnings was able to see them off, and they had to admit defeat, and they had to withdraw from the industry. And so that's why we really like Bunnings, because they have 5 times the market share of the nearest competitor. And even a really good retailer with heaps of balance sheet power like Woolworths weren't able to come in and attack that. So it's very unlikely that anyone else will be able to. So they've really got the market almost to themselves. And it's a great market. We love spending money on our houses. They've really been really smart about expanding the range. Everyone has a really great time, great sausage sizzles, all of that. Yep. So that's a business where you can kind of, as an individual experiencing it as a customer, you see why there's something special about it. So you've seen that kind of competition theory play out for them. CSL, understanding why they make high returns. you know, that's really a function of they've got every barrier to entry under the sun. You know, you need licenses to sell these products.
Yep.
You need a big footprint, so there's a capital barrier. You know, the patients don't want to switch to a new product they've never heard of. So once you've got a patient, they're pretty sticky. There's a lot, it's very complex stuff to make. There's a lot of manufacturing know-how. So they've got a lot of barriers to entry. And often they've got like a sole license to distribute a product. They've got a number of products where they've got what's called orphan drug status, which is the FDA. The FDA say, if you're going to invest R&D in tackling this really small market that only affects, you know, a really small amount of patients, we're going to let you have that market to yourself for 7 years in order to get a return on that investment. So they want to incentivize, because otherwise, why would you pick a really small market? You just go after the big markets, and people that are sitting there with, you know, really horrible lifelong conditions, but they're rare diseases, so there's only 1,000 of them, they're never going to get any sort of investment in new products. So the FDA incentivized that by awarding 7 years marketing exclusivity to anyone that succeeds with a product in those therapies. So they've got 5 or 6 products where they've got the market to themselves. So that's another type of competitive advantage.
Yes. Yep. And in terms of the sector, you're not looking at the portfolio. There's a wide array of businesses there. So it's more about obviously the competitive advantages, the quality of the business, return on equity. You know, so you don't have a favourite sector as such, Emma. Is that fair to say by the look of the portfolio?
Exactly. And it's funny, like, and I've said this before, like we try to stay open-minded. You know, if you take a sector like retail, for example. Now, a lot of people will think that retailers, they're not their cup of tea. They're very cyclical businesses.
Yep.
You know, you've got fixed costs, so you've got to pay the rent to the landlord. No matter how many people come in your store, the rent is a fixed cost. Your staff is a fixed cost. And so if sales fall, it's very hard to reduce your cost base, and your profits can really, you know, fluctuate. So a lot of people just don't like retailers.
Yeah.
But I actually think retailers, a certain type of retailer, can be some of your best investments, and they're pretty simple stories too. So what I like to see is you've proven out the concept, and you prove out the concept maybe across 15 stores. And then in Australia, if 15 stores really work and customers really like the product, you can roll that out across, you know, usually the yardstick I have in my head is maybe 300 stores in Australia.
Yes.
And that's an earnings compounder. It's very small amounts of capital. You know, one of the best examples of this, we've never owned it, but I've always admired it from afar and kicked myself, is Lovisa.
Yep.
So Lovisa is a really powerful earnings story because they're really tiny sites and they sell a lot of stuff from a very small site. So it's chump change to open one of these things.
Yes.
You know, very low rent, and very high, you know, sales per store. And so you've proven it out. If you picked up the stock a decade ago, you managed to get it when they'd just proven out the concept, and they were rolling out the stores in Australia. Now they've laid in the UK, and now they've laid in the US. So they can be really great earnings compounders as you ride that store rollout, you know, growth story. And one that we have owned in the fund, we didn't get Lovisa, but we got Nick Scali. You know, they IPO'd at $1, I think, about 10 years ago. Now the share price is 12, and that's really just been driven by rolling out store showrooms.
Yep.
And it's a really, you know, the other thing that makes retailers quite risky is their design team sits there. They're thinking 6 months ahead, and they say, we think consumers are going to want this next 6 months. And then they go and put the order on, and the stock comes, and then so you paid for it, and then you've got to wait to see if you sell it. And if you don't sell it, you've got to clear it. And so you can have these huge profit hits. This is what's happening to City Chic at the moment. They've got all this inventory. No one wants it. I remember their Black Friday website, they had 80% off site-wide. And then a couple of weeks later, they had a big downgrade because they're having to clear all this old inventory at any price they can get for it in order to generate cash to pay their bills. So that's one of the risks in investing in retailers is around inventory. And that's why we like Nick Scali, because when you go into their showroom and you sit down on a couch and you say, okay, I want one of these couches, you pay, and then they go make the couch. So they're making it custom to order, and you've already paid. So they're not
Yes.
ever caught holding the bag on all this stock that no one wants, because they're only making the stuff once you've ordered and paid for it. So understanding those nuances can be helpful too.
Absolutely. Yeah, I didn't understand that point around the stock and custom build when you order. I suppose opposed that at Premier Investments, Solomon Lew's business with Smiggle and Peter Alexander and a number of other brands. Obviously, Smiggle and Peter Alexander, they're two spearhead brands that they are expanding overseas at the moment. What's that rollout look like at the moment?
Yeah, so it's another one where I think in retail, you've really got to back the people that manage it. And Solomon Lew's just a phenomenal retailer. And Mark McInnes was great, the prior CEO, and now they've got Richard Murray, who was running JB Hi-Fi, did a really good job there too.
Yes.
So, and you back the people, because retail's about finding the right sites, finding the right people, in terms of the right culture and people that are incentivized to sell it as well. And then also good inventory management. So those are the three things I think that matter in retail. And they're an interesting one, Premier Investments, because they've got these two killer global brands in Smiggle and in Peter Alexander. So Peter Alexander isn't global yet, but I think that there's an opportunity there. But Smiggle in particular reminds me a bit of Lovisa in the sense that the economics of the business are great. They're really small format stores. They sell a lot of stuff, and each thing is worth not much. So real high turnover, high sales per store. They turn over the capital really quickly. So it's a really high returning rollout. So Smiggle, it's got global ambitions, and probably Peter Alexander as well. And then what they've been really smart at is they have this collection of other businesses like Just Jeans and JJ's and Portman. And they're pretty average businesses, but because they're run by a really good retailer, what he does is he wraps them all up together, and then he goes to the landlords, so shopping centres, and says, they know they want a Smiggle and they want a Peter Alexander because they really bring a lot of footfall in. And so they say, well, we're going to leave, we're going to shut all our shops and leave unless you meet us on rent. So they pay less as a % of sales than a lot of their competitors, because they use the collective bargaining power of the group in a really smart way, and they've been able to really cut some very, very good deals on rent, and that flows straight through to the bottom line. So again, it's just getting into the weeds of these businesses and understanding how much influence a management team can have if they know what they're doing.
Yep. And we'll stick with Premier Investments. Obviously, it's got a really nice holding in Breville, which is, the coffee I just had, morning tea, was our small little domestic awesome coffee machine. I prefer that than going to the cafe at the moment. But you're going back to the balance sheets. Obviously, a strong balance sheet is always preferred. No debt, investments, which Magellan has as well. Plenty of very strong balance sheet. You spend a lot of time analysing what's in the balance sheet for many of these businesses.
Yeah, we do, and you put your finger on it right there. I love a net cash balance sheet, because to me, it's a symbol of optionality, and it's something that no one ever puts any value on until they're forced to. And they might be forced to because the company turns around like Facebook and announces a huge buyback, or a big special dividend if they've got the franking credits, or maybe they go out and buy something and they get it at a great price. Either way, when those events happen where a company uses its great balance sheet, that's when suddenly the market wakes up to the value and the hidden optionality there. And that's when, you can really make a lot of money in the investment. So it's kind of like this hidden potentiality of a lazy balance sheet that we really like. And one example would be Reece. So Reece for years were net cash, and they were just growing in Australia and growing like a weed and doing a really, really good job. And it got to the point where they're actually pretty tapped out now in terms of market share in the Aussie market. And what they did, I'll always remember the day that I came into work and, there's an announcement that Reece have bought a big US business off private equity and they're doing a capital raising. I honestly nearly fell off my chair, because this is, it's everything you don't want to hear as an investor, massive red flags, capital raised by a business off private equity. Usually we'd want to run a mile from that. Going offshore, that's an absolute corporate graveyard of businesses that have gone offshore and torn up capital. And most recently, Bunnings obviously having a crack at the UK. So everything, my guard was up. And so part of it was a raise and part of it was debt funding. So they were able to take their net cash balance sheet and fund a lot of this themselves. And in fact, the Wilson family, and I've never seen this before, they wrote a check for $300 million so that they could have their own holding maintained in the raise. So they were putting their own money on the line, which is a great thing to see, and very unusual. So there were a few things. So normally, you know, my guardrails are up, looking at the detail of this, and then in talking to them, there are a lot of things that really got us comfortable with the deal. The first thing was, you know, they bought this big US business, and he went, and the CEO of Reese, who's part of the Wilson family, he went and spent the day with John Gillam, who was the guy that ran Australia Bunnings, and he also spearheaded the UK Bunnings acquisition. And he'd then left Bunnings. It had all come undone, and they exited the UK. So he sort of owned that era. And Peter Wilson went and spent a day with him and just said, what did you do wrong? Just let's do a postmortem, everything you did wrong so that we don't do that. And, you know, he said to him, we made too many changes too quickly. We didn't understand the local market. We should have just bought it, sat on it for a couple of years, understood the market before we started investing and swapping out all the inventory and putting in what we thought the UK market were going to want. So it was a bit of hubris and investing too quickly. So Reece said to us, you know, we're not going to make any changes for a year. The only thing we're going to do for the first year is we're going to instill our values in the business, because Reece have these really big firm values that they've got. So they flew out a lot of grassroots store managers from the US, brought them to Australia, got them to see what the Australian business was about, did a lot of work around their values. And apparently we were told, you know, through a bit of due diligence, not from the company that sells, but when the business got sold from private equity to the Wilson family, to Reece, people were literally cheering to hear that news, because they were worried about being owned by private equity and worried about who they were going to be sold to. And suddenly they're sold to this family company that made it very clear to them that they want to be there for the next, you know, 40 years. So, you know, there's something to all of that stuff that's really hard to, you know, put numbers around. But you know it when you see it, and you know it when you hear it. Like, it's really special. And the other thing is, so it was funny because at the time that they bought Morsco, the other big acquisition in the US was Boral buying Headwaters. So they bought a big US business as well. So we're going to these meetings basically at the same time with the two management teams. And Boral are like, you know, synergies, and literally lock this into your model. These are the synergies we're going to deliver. They were so bullish. They were so confident. And Reece we were asking them, oh, well, you know, you're buying stuff off, you know, you're buying toilets in Australia. You're going to be buying the same brand of toilets in the US. Do you think that you're going to be able to get some good terms there from the buying, blah, blah, blah? And they just said, you know, Emma and Matt, we're not banking any synergies. Don't put anything in your model. Maybe that comes over time, but let's just leave it as upside sort of thing. So the disparity between these two, one's trying to sandbag us and be very conservative, and the others, you know, off to the races. And 5 years later, Reece have doubled their money, doubled the earnings of the US business. And Boral have, you know, blown themselves up in the US and had to turn around and sell all of those businesses that they bought. So that's just another example again of, like, when we're backing these founder-led businesses or backing management teams that really know what they're doing, how you can get such different results.
Right. And while we're talking about the family businesses, and I remember seeing an interview you did a while ago that we're all now default Formula One fans because of Drive to Survive. And my boys introduced me to that. I had no interest in motorsport at all, and now we know the personalities, the politics, and the game itself. So back to PWR, with its reinvestment and obviously incredible engineer, is that business is it reinvesting to other areas? Is it more than just a one-trick pony of motorsport?
Yeah, and the answer is yes. And in fact, so the founder of the business, Keys, he was a mechanic. He's got a great origin story. He was a mechanic, and with his son, they said, we can make radiators, and they did. And then over time, they went more and more high end. And then they were at this trade show, and somebody from Red Bull came along and said, do you think you could make a radiator for Formula One? And Keys was about to say, no, we've got no idea how to do that. And the young guy he was with, you know, basically elbowed him in the ribs and said, yeah, of course, we can get you one in 3 weeks. So they had a crack, and Red Bull loved it. And the year that they implemented PWR's cooling systems was the first year that Sebastian Vettel won the championships for them. And he went on to win 6 years in a row. So from that, they went from just supplying Red Bull 15 years later, they've got everyone.
Everyone,
So,
right.
and you know, that's a great story, but then the other part of you as an investor is like, oh, well, are they tapped out in that? You know, is the growth over? And Keys will be the first to tell you that the motorsports business will be dwarfed by the division that they call emerging technologies today. Within 3 years, it's going to be bigger than motorsports, and not because motorsports will go backwards, but it will keep growing, but it's just going to grow faster. And the emerging technologies division, it's a few different applications, but at its core, it's sort of thermal properties. So they're in cooling systems.
Yes.
And it's applicable to cars, but it's also applicable to defense. Aerospace, unmanned, drones and things like that. Basically, when you think about when you're using a laptop, gets really hot on your lap, it needs a cooling system behind it. So a lot of electronics need a cooling system as well. And so they're doing really high-end applications, bespoke sort of prototyping and things like that. And they're able to tackle that market because they're set up to service these customers that have really short lead times. And you have to work really closely with the separate engineering teams of each company, because they're basically like, well, let's do it this way. Now let's try it that way. And by the way, we want it in 2 weeks' time. So, this really short prototyping, testing it. They've got a wind testing facility on site. So they can test things from end to end and put it in a product and it be, Formula One grade. And so that's opened up a lot of optionality in working with really, really high-end customers in aerospace and defense who like the fact that these guys can operate to short lead times, that can take everything from design through to a finished product, rather than because with aerospace in particular, the barrier to entry, I suppose, is you need accreditation to be a supplier, to be an input, because obviously everything about aerospace is so heavily regulated. So it's really hard to get accreditation. And they've recently got it. It involves a hell of a lot of site visits and a lot of due diligence from these international bodies. And so that accreditation means that they'll be able to really offer as much as they can to these companies. Rather than these companies have to deal with 50 different suppliers for things, they can just deal with PWR. So we think there's a lot of opportunity there. That business is, doubling year after year, and it's really, really exciting. So it is a motorsport story today. It's about half their revenue, but it's not the full story. And I think a lot of the growth is going to come from that emerging technologies piece.
Yeah, fantastic. Great explanation. Now, Emma, we sent through a whole list of questions. I think I've asked nearly none of those, which I knew, that's right, I knew you wouldn't have needed. But I suppose one question I've got, we're all Warren Buffett and Charlie Munger fans, and obviously a lot of fund managers speak to them as inspiration and part of their own journey. What is your key learning from Warren Buffett and Berkshire Hathaway, Charlie Munger? Yeah, do you have a key takeout for you?
Yeah, I think what's just so unique about those guys is their ability to distill really complex concepts into these really pithy sayings that stick in your mind. And that's why we all love to quote them, because we've all had all these experiences and a quote springs to mind, and they've just been, the masterminds of translating the stuff that we're experiencing every day into these little sayings. And my personal favorite one, very overquoted, but this: be greedy when others are fearful and fearful when others are greedy. I think that's a really great test to use in the markets. If you look at so you can use it in two ways. Firstly, if you're an individual investor, answering the question of when's a good time to put money to work in the market. I mean, I would argue your strategy could be just put it in all the time, and sometimes the market's high and sometimes the market's low. But every now and then you get these opportunities. I think last year was an example where there's a lot of fear around, and it might be a good time to sort of scale up how much money you're putting into the market. And so that's a really good just sense check of, are people fearful or greedy right now? And it was quite stark. 2021, there was so much greed. Much greed. And you saw it, you saw it in crypto, you saw it in the tech valuations, you saw it in house prices. There's the fear to greed sentiment was really, really extremely on the greed side. And then it swung really quickly onto the fear side. And suddenly there was war and we're never going to be able to get energy prices back into the bottle and all of this stuff. So you can feel it. I always throw my mum in it a bit, but I always use her as my reverse indicator, because she's she's got her own little share portfolio, and whenever I get a text going, oh, my shares are up so much, that's usually when the market peaks.
Yes.
And when she's telling me the market's I'm not going to invest anymore because the market's going to keep falling, that's usually a good sign at the bottom. So you look out for those indicators. It used to be when your dentist is giving you stock tips. I think now it's when your Uber driver is giving you stock tips. It's usually a sign that the market's probably close to a peak.
Yeah, and I've seen more anxiety over the last 12 months, even more than what we saw during COVID. Everyone just expected it to be horrible, but with interest rates going up and the media playing such a huge role, that the pessimism I've seen and anxiety, it was higher than the GFC, higher than 2020. And, and people saying, well, I think it's going to get a lot worse from here. But yeah, they've been trained, to think that the sky's falling by media. And as I always said to them, I will call you when, to invest when you least feel like investing. And that's when Buffett's at his best. And that's when he's sitting on cash because he's more patient than everyone.
Absolutely. And I think that, it's a good word, that anxiety, because I think everyone feels it. And it's sort of anxiety in the collective as well. But I think one of the best skills to have as an investor is optimism. And just realizing, there's always a tendency, particularly it comes about when the market starts falling. There's this tendency to think things look interesting. Maybe I want to put some money in the markets, but what if this is the big one? What if this is, the unraveling of the financial order?
Yep.
And if you just tell yourself it's probably not the big one,
yep,
more times than not, you'll make good money. And having that attitude of just, buying when you get these little opportunities to buy things when the market falls 20%. That's in most permutations of a cycle. You think market's down 1 year out of 7, it's up 6 years out of 7, and just don't look.
Yep.
And also you're never going to pick the bottom. You've got to buy and be very well prepared. Things are going to keep falling. Picking the bottom, if you're waiting for that, then that's an art that I don't think anybody has. So it's just the advantage of turning off screen, going for a walk, getting out in nature, and just realizing that this. I always remember this. My first job, I was working on the sell side, and I worked with a guy who used to be an orthopedic surgeon and had done some time working in hospitals and working in emergency rooms. And somebody that I worked with said, he'd had a blow up in a stock, and he said, oh God, this job is so stressful sometimes. And this former doctor turned around and said, this job isn't stressful. Stressful is telling somebody that their kid didn't make it when they're in a car accident or something like that. This is not life or death. As professional investors, we wear the weight of responsibility of investing other people's money. But as long as we're paying attention to balance sheets and things like that and risk, then we're taking care of that. But I think we need to all collectively take the pressure off ourselves and just realize that we invest because it's a fun thing to do, and it keeps you connected to life, and it gets you interested in things. It's a way to expand your knowledge base. So having that sense of optimism, I think, is a good way to kind of cut through the doom and gloom and not take things so seriously.
Yeah. Fantastic, Emma. I think we might leave it at that. There was an amazing discussion. I think I could be asking you questions for the whole day, but I won't do that to you. You've got a job and a family to attend to. So Emma Fish from Airlie Funds Management, thank you so much for your time. And
thank you.
Appreciate the chat.
Thanks so much for having me, Rob.
You're welcome.